Ladies and gentlemen, global investors watching from New York to London, from Singapore to Frankfurt, the moment you feel safest is often the moment risk quietly peaks. Gold has just reached levels that history remembers, not for protection, but for painful lessons. When headlines celebrate new highs, when charts look unstoppable, when fear of inflation feels justified, this is where most investors lose money. Not because gold fails, but because human behavior does. Gold does not move in isolation. It moves when confidence breaks, when currencies weaken, when central banks hesitate, and when uncertainty becomes a global language. Over the past years, inflation has reshaped financial reality. In the United States, consumer prices surged to levels not seen in 4 decades, peaking above 9% before gradually easing. In Europe, energy shocks and supply constraints pushed inflation to historic extremes. Even as headline numbers cooled, the damage to purchasing power remained real. Food costs, housing, healthcare, these are not abstract statistics. They are daily reminders that money buys less than it used to. Against this backdrop, gold surged. Central banks paused, then tightened, then signaled uncertainty. The Federal Reserve raised interest rates at the fastest pace in modern history, lifting the federal funds rate from near 0 to above 5%. The European Central Bank followed, breaking a long era of negative rates. The Bank of Japan, for decades an outlier, began adjusting its yield curve controls. In theory, higher interest rates should pressure gold because gold yields nothing. In reality, gold climbed anyway. That contradiction tells a deeper story. Gold rises most aggressively not when inflation is high, but when trust is fragile. When investors no longer believe central banks can fully control outcomes, when debt levels feel unsustainable, when geopolitics add a premium of fear. According to World Gold Council data, central banks purchased more gold in recent years than at any time since records began. Nations diversified away from dollar exposure, not loudly, but steadily. Institutional flows followed. Exchange-traded products linked to gold saw renewed interest during periods of market stress. The message was clear. Gold was no longer just a hedge. It was a statement. Retail investors felt it too. Search trends for gold spiked. Coin dealers reported shortages. Social feeds filled with charts pointing upward, framed as proof that gold was finally doing what it's supposed to do. This is the psychological tipping point. When protection turns into conviction. When caution becomes confidence. When people stop asking what they're paying and focus only on why they're buying. History has seen this movie before. In 1980, gold surged amid runaway inflation, oil shocks, and geopolitical tension. Investors piled in near the peak, convinced the system was broken beyond repair. What followed was not collapse but disappointment. Gold entered a 2-decade period of stagnation, losing purchasing power while investors waited for the next crisis that never arrived in the same form. In 2011, gold reached another historic high after the global financial crisis. Fear dominated. Central banks printed trillions. The narrative felt airtight. Over the next several years, gold fell sharply, not because risk disappeared, but because expectations had already priced in catastrophe. This is the pattern few want to acknowledge at the top. Gold does not peak when risks vanish. It peaks when risks are fully accepted, fully discussed, fully feared, when everyone agrees on the reason to own it. Markets rarely reward consensus. They punish it quietly, slowly, then suddenly. Listen closely to the language used at peaks. This time is different. Currencies are being debased. Debt will never be repaid. These statements may contain truth, but markets trade on timing, not truth alone. Gold can be fundamentally justified and still be overpriced in the short to medium term. That distinction is where investors struggle. The chart looks safe because it went up. The headlines feel validating because they echo personal anxiety. Inflation eroded savings, so buying gold feels like taking control. Many investors look back and say, I bought at the top, not because they were reckless, but because they were human. Because waiting felt riskier than acting. Because doing nothing felt irresponsible. Smart money behaves differently. Large institutions accumulate when fear is absent, when gold is ignored, when holding it feels boring. They distribute when narratives become emotional, when retail demand surges, when every pullback is framed as a buying opportunity. This is not conspiracy, it is structure. Markets transfer assets from impatient hands to patient ones. The most dangerous assumption at a peak is that gold cannot fall because the world feels unstable. Instability is not a trigger, it is the baseline. What matters is whether instability is increasing faster than expectations. When fear stops rising, price momentum often does too. This is not an argument against gold. It is a warning about timing and psychology. Gold is a long-term store of value, not a guarantee of short-term safety. Buying it at elevated levels does not make someone foolish. Believing it cannot correct does. Losses rarely come from being wrong about the world. They come from being wrong about price. As gold reaches peak sentiment, the real question is not what gold will do next, but how investors will react when it stops doing what they expect. Will they hold through volatility, understanding the role they assign to it, or will fear turn inward, transforming protection into regret? Markets do not punish fear, they punish late fear. And at the peak, fear has already been fully priced in. Global investors, this is where the story becomes uncomfortable, because the greatest losses rarely happen during collapse. They happen during calm, after the peak, after the headlines fade, after volatility narrows, and patience runs out. This is the phase where gold doesn't crash spectacularly. It drifts, hesitates, retraces, and slowly drains conviction. And that slow grind is far more destructive to capital and confidence than a sudden drop. When gold reaches peak levels, price action often changes character. Volatility compresses, rallies become shorter, pullbacks feel manageable at first. Each dip is bought, not because of analysis, but because of memory. Investors remember how quickly gold recovered before. They remember why they bought it. They anchor to the highest price they saw and treat it as a reference point, not a warning. Behavioral finance calls this anchoring bias, and it is one of the most expensive mistakes in market history. Data reinforces this pattern. After gold peaked in 2011 near $1,900 per ounce, it didn't collapse overnight. It spent months moving sideways, giving investors hope. Then it declined steadily, losing more than 40% over the following years. Inflation did not disappear. Debt continued to rise. Central banks continued to intervene, yet gold underperformed. Not because the thesis was false, but because the price had already discounted the fear. This is where most investors lose money, not at the moment of buying, but in the months and years after, when opportunity cost quietly accumulates. Capital sits idle, other assets recover, equities rebound, real yields shift, and gold holders, convinced they made a defensive choice, watch purchasing power erode through stagnation rather than collapse. Institutional behavior during these periods is telling. Commitment of traders reports historically show that when speculative long positions reach extremes, future returns tend to disappoint. Large players reduce exposure not with urgency, but with discipline. They rebalance, they hedge, they rotate. Retail investors, meanwhile, personalize the trade. Gold becomes a belief, not a position. Selling feels like betrayal of logic, not adjustment of risk. Central bank policy plays a critical role here. When inflation peaks, even if it remains elevated, policy expectations shift. Markets begin to price stabilization rather than escalation. The Federal Reserve does not need to cut rates aggressively for gold to stall. It only needs to signal credibility. Even the perception that inflation is less out of control can cap gold's upside. Real interest rates matter more than nominal ones, and when real yields rise, even modestly, gold faces headwinds. In Europe, similar dynamics unfold. Inflation shocks push gold higher, but fiscal responses, energy normalization, and policy tightening eventually reduce tail risk pricing. In Japan, decades of deflationary mindset limit domestic gold demand despite currency weakness. Globally, gold trades not on one country's crisis, but on the aggregate trajectory of fear. Retail psychology struggles with this nuance. Many investors believe gold must continue rising because problems remain unresolved. But markets do not wait for resolution. They trade the rate of change. When problems stop getting worse at an accelerating pace, assets built on fear lose momentum. This is where regret begins to form. Not dramatic regret, but quiet doubt. Investors stop checking prices daily. Then they check less often. Then they rationalize holding because selling would lock in disappointment. Loss aversion takes over. Studies consistently show that investors feel losses roughly twice as intensely as gains. Holding becomes emotionally easier than admitting poor timing. "I bought at the top" is rarely said immediately. It's said years later, looking back at a flat or declining chart, realizing time itself became the cost. Gold did not collapse. It simply failed to perform the job investors unconsciously assigned to it: immediate relief. There is also a structural misunderstanding about gold's role. Gold is not an income-generating asset. It does not compound. Its strength lies in preservation, not growth. Buying it aggressively at elevated prices with expectations of strong returns creates a mismatch between asset behavior and investor psychology. That mismatch is where frustration turns into loss. Smart money understands this asymmetry. Gold is accumulated quietly and held patiently, often as a hedge against extreme outcomes, not as a primary engine of returns. When sentiment becomes euphoric, allocations are adjusted downward, not because disaster is impossible, but because upside is limited relative to downside. This is not market manipulation, it is risk management. The same discipline missing from most retail decisions at peaks. The irony is painful. Investors buy gold to reduce stress, yet buying it at peak sentiment often increases stress over time. The asset that felt like safety becomes a reminder of miscalculation. Not because gold failed, but because expectations were unrealistic. History didn't repeat, but it rhymed. Over and over, across decades, across crises, across currencies. Peaks are not marked by disaster. They are marked by agreement. Agreement that gold makes sense. Agreement that this time is justified. Agreement that waiting is riskier than acting. And when everyone agrees, markets listen and move the other way. Ladies and gentlemen, this is where the lesson becomes larger than gold itself. Because what happens after the peak is never really about the metal. It is about decisions made under pressure, about narratives trusted too deeply, and about the human tendency to confuse safety with certainty. Gold exposes this better than almost any asset because it sits at the intersection of fear, history, and belief. When gold stalls after reaching extreme levels, investors are forced into a psychological confrontation. The original reasons for buying are still there. Inflation has not vanished. Debt has not been erased. Geopolitical risk has not dissolved. Yet price no longer responds the way it once did. This creates cognitive dissonance. If the reasons remain valid, why isn't gold moving higher? That question quietly erodes confidence. At this stage, many investors double down emotionally. They search for confirmation, not information. They gravitate toward analysts predicting higher highs, longer-term targets, structural breakdowns of the monetary system. The narrative hardens. Gold is no longer just protection. It becomes proof of being right. And when an investment becomes tied to identity, risk management disappears. Meanwhile, the market is doing something very different. Liquidity shifts, capital rotates. As inflation stabilizes, even at elevated levels, other assets begin to reprice opportunity. Equity markets start to recover, not because conditions are perfect, but because expectations were too pessimistic. Credit spreads tighten, risk premiums compress. Gold, designed to protect against extreme outcomes, becomes less urgent to hold at the margin. Data consistently shows this transition. Periods following peak inflation often coincide with rising real yields, even if nominal rates remain unchanged. This environment is historically challenging for gold. It doesn't require strong economic growth, only the perception that the worst-case scenario is less likely than before. That subtle shift is enough to cap upside. This is where most investors lose money not through panic selling, but through indecision. They wait for gold to come back to validate the original decision. They ignore opportunity cost because it feels invisible. Months pass, years pass. The emotional weight grows heavier than the financial one. Eventually, many exit not at the top, not even near it, but after prolonged disappointment. They sell when gold feels irrelevant, not dangerous. This is the quiet transfer of loss that rarely makes headlines. The pain is not sharp enough to be memorable, but deep enough to be permanent. The phrase, "the chart looked safe," becomes clear only in hindsight. At peaks, charts look stable because volatility has already done its work. The violent move happened on the way up. What follows is often normalization, not continuation. Stability at high levels is not safety, it is saturation. Gold's long-term value is undeniable. Over centuries, it has preserved purchasing power through wars, collapses, and monetary resets. But long-term truth does not protect short-term behavior. Investors who confuse gold's historical role with guaranteed timing repeat the same mistake generation after generation. This is why history rhymes. Not because markets are predictable, but because people are. Fear of inflation drives buying. Relief drives selling. Regret fills the space in between. The asset changes. The story does not. The most important realization is this. Buying gold at peak sentiment is rarely a failure of intelligence. It is a failure of emotional calibration. Investors correctly identify risk, but misjudge when that risk is already reflected in price. They act when the problem feels urgent, not when the market offers favorable terms. Gold is not the villain in this story, nor are central banks, inflation statistics, or global instability. The true risk lies in believing that an asset designed to hedge uncertainty can remove uncertainty altogether. It cannot. No asset can. When gold hits the peak, the danger is not an immediate collapse. The danger is complacency. The slow realization that protection does not equal performance, and that safety purchased at the wrong price carries its own cost. This is where awareness matters. Not to predict the next move, not to call tops or bottoms, but to understand behavior. Because the moment everyone feels aligned, reassured, and justified, markets begin searching for imbalance elsewhere. If you're watching from anywhere in the world, the lesson is universal. Markets reward discipline, not emotion. They punish certainty, not caution. And they remind investors again and again that the most crowded trades are often the most dangerous. Not because they are wrong, but because they are late. Gold just hit the peak. And for many, the real test is not what gold does next, but whether they recognize that the greatest risk has already arrived quietly, disguised as comfort.